Hey guys, if you're studying for your CFA exams and you're struggling to understand and retain the information, this video is going to help. Now, I use this technique throughout my studies and it was a key part of why I was able to pass all 3 exams first time with 90th percentile scores at all applicable levels. Now, if you don't know me, I'm Harris, an investment banker and CFA charter holder, studied at Imperial College London. Right, let's dive into it. And the absolute key to me being able to understand, retain and apply complex concepts throughout my CFA journey was first principle thinking. And for those of you who don't know what that is and why it's so powerful, let's break it down and we'll look at some examples. Now, one of the biggest challenges with the CFA is the sheer volume of content you need to get through and the number of formulas you need to remember. Not only is there a ton of information at each level builds on the previous level and assumes strong understanding of prior concepts, and the amount of application increases. And this can make studying for the CFA overwhelming because not only do you have to understand and retain these concepts, you also have to apply them. Now, there's one simple truth. You simply cannot succeed with the CFA program whilst relying on memorization alone. You need to understand things at a deep fundamental level. Now, think of your learning process as growing a tree. The trunk represents the core foundational principles that support everything else. The branches are the secondary layer of understanding that you build on the trunk. And the leaves represent the finer details and application which only makes sense once you firmly establish the trunk and the branches. So you can't start hanging the leaves on the tree without ensuring the trunk and the branches are solid first. Similarly, with the CFA program, you have to establish the fundamentals first before you move on to the complex topics and the application. And the ability to take these fundamental concepts and assemble them in a way that helps you answer any question that you're faced with is first principle thinking. And we'll look at some examples of how this works in reality shortly. Now, let's look at the power of first principle thinking. Now, this involves breaking things down into simpler terms and assembling them to get to where you need to go rather than remembering the solution itself. And it's something that incredibly successful people like Warren Buffett, Jeff Bezos, and Elon Musk have used to build their empires. In fact, when Elon Musk and his company SpaceX were developing rockets, they approached it in the following way. Now, the traditional thinking was that rockets were expensive because they always have been. By applying first principle thinking, they broke the cost of producing rockets down to the cost of its components, such as aluminium, carbon fiber and fuel. And they asked, how can we optimize the cost of these components? And they reasoned that it would be most cost effective to design reusable rockets, which wasn't really a thing at that point. And ultimately this drastically reduced launch costs. So let's look at a few things first principle thinking enables. So firstly, understanding the why behind concepts. So instead of memorizing the concept or the formula, understand why it works and the logic behind it. For example, understanding time value of money as a fundamental principle allows you to derive different formulas such as future value, present value, and annuities rather than having to memorize all the formulas. Secondly, you can apply these concepts in different scenarios. CFA exam questions, particularly at level 2 and 3, test your ability to apply knowledge to varied contexts. A first principles approach allows you to be flexible. If you memorize or rote learn, you only ever learn to apply that knowledge in one specific context. And finally, first principle thinking allows you to retain information more effectively. When you build understanding from the ground up, you create mental connections, which makes it easier to recall and apply information. Now, before we look at examples, more than 50% of people fail their CFA exams because they don't have the right strategy, they're not efficient learners, and they don't have anyone to turn to for help. And in the process, they waste hundreds of hours and thousands of dollars on resits. So if you want to avoid this and pass your CFA exams first time without sacrificing your entire life, I have something perfect for you. Check out the first link in the description. Okay, let's look at a couple of examples, and the first one is callable bonds. So let's say you're faced with the question, what is the formula for a callable bond when compared to a non-callable bond? Now, if you take the memorization approach, you might try and remember that callable bonds have a lower price or a higher yield, and that the formula is callable bond price equals non-callable bond price minus the value of the call option to the issuer. But if you forget this relationship or formula in the exam, you're screwed. Instead, let's break it down to first principles. So firstly, what is a callable bond? Well, it's a bond which gives the issuer the right to call the bond or redeem the bond at a date before maturity, typically at a fixed price, which is the call price. So why does it have a different value to non-callable bonds? Well, let's look at it from the issuer's perspective and the investor's perspective. Well, from the issuer's perspective, a callable bond is valuable because it allows them to redeem the bond and reissue the bond at a lower interest rate if market rates fall, which is a good thing. From the investor's view, they're exposed to reinvestment risk because if that bond gets called, they have to redeploy the capital that they get back into a new bond that likely has a lower coupon. So that's not a good thing from the investor's perspective. So how does this impact the price? Well, since the call option benefits the issuer, not the investor, you'd expect a deduction in price versus a non-callable bond. So a callable bond will have a lower price. And recalling the relationship between price and yield, which is the opposite relationship or inverse, if the price is lower, the yield must be higher to compensate the investor for this risk. So based on this, we can arrive at the formula that a callable bond's price is a non-callable bond price minus the value of the call option to the issuer. Real quick, if you're wondering which prep providers to use to supercharge your CFA learning, I have two superb options for you with some exclusive discounts just for you. The first is IFT, which I've been shouting about for a long time, and they're amazing. They have concise lectures and notes which focus on the most testable material, which almost always comes up in the exam. Their notes are superb, and buying these will save you tons of time, and to top it off, I've secured you an exclusive 10% discount. The coupon and links are in the description. The second is Analyst Prep, which also offers pre-made notes alongside unique 24/7 candidate support where experts answer your CFA questions. They're also affordable at $799 for all 3 CFA levels, which is less than some prep providers charge for just one level. I've also secured you a further 20% off. The coupon and links are in the description. Now let's look at another example, which is the Gordon growth model in equity valuation. Now the traditional approach would be to just memorize the formula, which is V0 equals D1 over R minus G. And in terms of components, V0 is the stock price today, D1 is the expected dividend in the next period, R is the required rate of return, and G is the constant growth rate of the dividend. Now let's apply first principles and dissect how the formula works. Now we use the Gordon growth model when we expect a stock to pay a dividend indefinitely, so it's typically a mature company that has an established record of paying a dividend. So therefore it's like an annuity with a consistent expected payout, so we can use the perpetuity formula from time value of money. So the perpetuity formula is PV equals C over R, where PV is present value, C is cash flow, and R is required return. And required return can be used interchangeably with discount rate. And the discount rate represents the opportunity cost of the investment, i.e. the yield we could have got elsewhere if we invested at the risk-free rate. And this also represents the risk of the investment. Now here, the present value in question is the price of the stock, so V0, and the cash flow in question is the dividend, so D1. So we get V0 equals D1 over R. But the dividend also grows at a constant rate, which is G, so this should offset the discount rate, so we end up with V0 equals D1 over R minus G. So even if we forget the formula for the Gordon growth model, we can just start with the perpetuity formula and remember that the dividend also grows, so we can arrive at the final formula. So there you have it. First principle thinking was crucial in me conquering my CFA journey, and it will help you too. If you like this video, then you're going to love these two on screen, and otherwise thanks for your time and see you in the next video.